Welcome to our deep dive on maximizing wealth for self-employed professionals, especially S-Corp owners. Today we'll show you how to use solo 401k strategies to reduce taxes, avoid high fees, and build a globally diversified portfolio. We'll also share a simple implementation plan and common pitfalls to avoid. Let's move from big picture to specifics so you can take decisive action right after this video. Here's our roadmap. First, we'll lay out the big idea. Then examine solo 401k contribution mechanics for S-Corp owners. Next, we'll expose the cost of fees and why consolidation matters. Then we'll cover liquidity best practices, including emergency funds and 529 plans. After that, we'll address diversification, comparing US only versus global. We'll wrap with a practical action plan, 2 short quizzes, and key takeaways, plus a disclaimer. Now let's set the stage. The reason this matters is simple. Many self-employed professionals are leaving large tax advantages unused, paying unnecessary fees, and concentrating too heavily in the U.S. market. By structuring accounts correctly, taking immediate action to reduce high fees, and diversifying globally, you can improve after-tax returns and reduce risk. With that context, let's break down the solo 401k mechanics for S-Corp owners. For S-Corp owners, the solo 401k is especially powerful because you can combine an employee elective deferral with an employer profit-sharing contribution. For 2024, the employee deferral limit is up to $23,000, with an additional $7,500 catch-up for those age 50 or older. On top of that, the employer contribution can be up to 25% of W-2 wages, not distributions. The total combined limit is up to $69,000 in 2024, or $76,500 with catch-up. This often exceeds the contribution limit of basic IRAs significantly, which is why many self-employed individuals are underutilizing their available deductions. As we transition to implementation, remember to coordinate Roth versus traditional contributions with your CPA to match your tax situation. Here is the action sequence. First, choose a solo 401k provider that has low fees and an intuitive platform. Second, ensure payroll is configured correctly, because W-2 wages determine your employer 25% calculation. Third, make employee deferral elections early and follow payroll timing rules. Fourth, make employer profit-sharing contributions by your business tax filing deadline, including extensions if applicable. Fifth, consolidate legacy accounts into one low-cost platform to simplify management. Sixth, select broadly diversified, low-cost index funds such as a total U.S. market ETF paired with an international ETF, and add bonds if your risk tolerance or time horizon requires it. Seventh, automate contributions and create rebalancing reminders so the plan runs on autopilot. Next, let's compare portfolio approaches. On the left, a U.S.-only portfolio using an S&P 500 or total U.S. market fund is simple and has benefited from strong historical performance. However, it concentrates risk within one country and one currency, making the portfolio vulnerable if the U.S. underperforms for a prolonged period. On the right, a global portfolio pairs total U.S. exposure with international equities, distributing risk across markets and potentially smoothing return variability. Given the uncertainty of future leadership among countries, global diversification can act as strategic insurance. This table illustrates fee drag over 30 years on a $250,000 starting balance with a 7% gross return. With zero fees, the ending value is approximately $1.903 million. Using a very low-cost ETF at 0.04% results in about $1.882 million, a small reduction. However, paying a 1% annual fee drops the net return to roughly 6%. And the ending value to about $1.435 million. The difference between very low fees and 1% fees is nearly $450,000 over this horizon. Next, let's translate this into a simple, diversified allocation. This pie chart presents an example diversified allocation with 55% U.S. total market, 35% international ex-U.S., and 10% bonds. The goal is to capture broad global equity exposure while retaining a modest bond allocation for stability. Investors with shorter horizons or lower risk tolerance might increase the bond slice, while those with longer horizons could decrease it. Now let's map out contribution timing across the year. The timeline shows an annual rhythm. In the first quarter, elect employee deferrals. Automate contributions on each paycheck. By December 31st, employee deferrals must be completed via payroll. Employer profit-sharing contributions can typically be made by the business tax filing deadline, including extensions. Each quarter, rebalance and review fees. At year-end, confirm contribution totals and ensure documentation is accurate. With timing clear, let's ensure your liquidity is safely handled. Your emergency fund belongs in a high-yield savings account, typically covering 3 to 6 months of expenses, and business owners should consider 6 months or more because of variable cash flow. For taxable investing, use low-cost ETFs and avoid unnecessary trading to reduce taxes. For college savings, prioritize 529 plans for tax-advantaged growth. As a guiding rule, keep short-term money safe and only invest funds that you can leave untouched for long-term goals. Next, let's add a quick quiz to reinforce the key numbers. Question: in 2024, what is the maximum total solo 401k contribution for an S-Corp owner, combining employee and employer contributions, excluding catch-up? Options are $22,500, $27,000, $69,000, or $76,500. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is $69,000. For 2024, the total solo 401k contribution limit is $69,000, or $76,500 if you are eligible for the age 50+ catch-up. Now, let's test liquidity knowledge. Question: where should a business owner keep their emergency fund? Options are in a high-yield savings account, in a long-term stock ETF, in a 529 plan, or in a speculative cryptocurrency. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is in a high-yield savings account. Emergency funds require liquidity and safety, so they should not be exposed to market risk or volatility. Next, let's reinforce key takeaways and then cover a brief disclaimer. Here are the key points. First, recalculate your solo 401k limits, because employee plus employer can reach $69,000 in 2024. Second, cut high fees by switching from 1% or higher funds to low-cost index ETFs. Third, simplify by consolidating accounts on one low-cost platform. Fourth, diversify globally and avoid home country bias by adding international exposure. Fifth, protect liquidity by maintaining 3 to 6 months of expenses in a high-yield savings account and consider 529 plans for college savings. Sixth, automate contributions and rebalance periodically. This content is for educational purposes only and does not constitute tax, legal, or investment advice. Consult a qualified CPA or fiduciary financial advisor who understands your individual circumstances, entity type, and state regulations before implementing any strategies discussed. To wrap up, open a low-cost solo 401k and ensure payroll is configured properly. Elect employee deferrals early and plan employer contributions by tax filing deadlines. Consolidate accounts and move to low-cost index ETFs. Adopt a global allocation and implement rebalancing rules. Finally, secure your emergency reserve and use 529 plans when appropriate. Before we close, here's a final thank you and call to action. Thanks for watching. If this helped, please like the video, share it with another business owner, and subscribe for more practical strategies. Tell us in the comments how you're optimizing your solo 401k, cutting fees, and structuring your global allocation. Your insights might help someone else take action.